The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the DFK Australia New Zealand webinar today about succession planning, how you can plan for a profitable and painless exit from your business. My name's Angela Raspas and I'm your host for today's webinar training, and I'll shortly be introducing you to Stephen Bushell and Gary Nugent, who'll be taking you through the ins and outs of succession planning success. A little bit of homework before I hand you over to the guys, Stephen and Gary, as you'll see on your screen now. We do have some handouts that are associated with this particular webinar, which you'll be able to see in the control panel on your screen. One is an infographic, which gives an overview of the steps involved in putting together a successful succession plan, and also a PDF, which takes you through the valuation guidelines associated with getting your business ready for sale. You are also very welcome to pop in any questions that you have in the chat box in the control panel, and we'll be handling those at the end of the webinar. So if you have a specific scenario that you would like some insight on, please pop it in as we go along. Now, we like to start our webinars with a little bit of a taste of what's in store, and here's what we believe. Succession planning is a process for identifying and developing new leaders who can replace the old leaders when they leave, retire, or die. And we, in our annual wavelength survey, just found that 53% of business owners don't have a succession plan in place. Now, that was a worry for us, and that's why we decided to put this webinar together so we can change that for you. So it's our goal today to assist you to explore your options, to confidently navigate the potential pitfalls, and to create a clear action plan that you can implement so your succession planning goes smoothly. Now, what we'll be covering today is what a plan actually is and why it is so important for each business owner to have one. We'll be looking at the internal and external succession options, pinpointing the essential steps that are involved in developing not just a plan, but a really strong one. Looking at the major challenges that most business owners will need to face and how to overcome them. The importance of navigating the tax and the structure implications in the way that your succession plan is going to happen. Really understanding those core business valuation guidelines I mentioned before. And most importantly, putting together a simple but thorough action plan to move you forward. We'll also, recognizing that there's only so much that we can take care of in a 1 hour presentation, you'll also be invited to go and get a complimentary succession planning discussion with one of our advisors. Now, there will be a link towards the end of the presentation that you can grab and apply for one of those sessions. And then we'll be back in touch with you quickly to put you into a discussion with an advisor that's physically close to where you're located. Now, we would ask to start our webinars, we do like to do a couple of quick polls. It helps the presenters understand who's on the call so we can tailor our examples more specifically for you. So when these polls pop up on the screen, if you can just take a moment to put your answer in, that really allows us to make this presentation more valuable for you. So the first one, which I shall just launch, is do you feel you have a clear picture of what your business is worth at this point in time? If you can pop in there and give us a simple yes or no answer, that would be wonderful. Okay, at the moment, the no's have it. We've just hit the 50-50 mark. So just waiting for the balance of votes to come in there, getting close. Okay, fascinating. We've got an absolute 50-50 vote here at the moment. So thank you for that. I shall bring up the next one. Okay, this is giving us an understanding of where you're at in terms of planning your succession. Are you looking at implementing your own succession plan, once you have one, under 2 years, less than 5 years, or over the 5-year mark? Again, gives us an understanding of where our audience is at, so we can make our examples more relevant for you. Okay, wonderful. We've had half the vote, so if you can just take a quick moment to pop in your thoughts there. Dun-dun-dun-dun. Okay, we've got a pretty good split. There's 40% looking at 5+, 32% less than 5 years, and 21%, it's coming up soon, under 2 years. Thank you. And 2 more quick ones to go. Okay, who is your succession plan likely to involve? What do you feel at the moment? An external purchaser, existing staff member, a family member, something else? Or do you don't think that that's possible for you to pass on or sell the business in its current structure? A lot of consultants believe that, but there's a way through. It looks like at the moment, again, good split. Family members are high on the options here. For the people who've mentioned other, if you could, when you have a moment, type into the chat area and give us an understanding of what those others might be. Okay, we're almost finished the voting on that one. Let's wait a couple more seconds. Okay. Thank you, everyone. And the very last one is just for us to understand what industry you are in. The core ones we can fit on the room that GoToWebinar allows us is professional services, manufacturing, retail, hospitality, or other. Again, if you could just pop what that other is down into the chat box, that will be really helpful for us. We have a strong showing here in professional services. We've got some manufacturing, some hospitality. Oh, a retailer just popped up. And lots of others. So yes, just a quick entry in the chat box would be really helpful. Okay, close to everyone having voted. Just wait there a couple more moments. Wonderful. Thank you, guys. That makes it a lot easier for us to make this more valuable for you. So I am now going to pass on to Gary Nugent, who will be our first presenter on today's webinar, talking about what is a succession plan and why every business owner needs one. Thank you, Gary, and I'll be back again after you go.
Thanks, Angela. In terms of this this topic, it's certainly a complex one. To be clear, the individual and peculiar nature of everyone's business, whether they're looking at it from the point of the nature of their own business, the vendors that or the purchasers that might be likely to be a buyer, the family interactions, all of those things make business succession a very interesting area to get advice upon. And really, at the end of the day, a lot of business owners put it off for a long period of time. But unless you're sort of immortal, then the process of succession is inevitable. So, like any plan, better to start it soon, and the sooner you do it, the better the outcome. As Stephen Covey said, to start with the end in mind. And if that start is now to create the value in your business, well, then far better that, and create the long-term value that your business is certainly worth. So on the screen, we sort of note quite a number of points that need to be addressed. But in the main, if you look at it from the point of the change that's upon us, you need to look not just at what your business has been for the last 5 to 10 years, but what your business potentially could be, and creating a sense of that a purchaser could see and thus would be prepared to pay you a sum of money to fast track that growth for them. Obviously, personal circumstances are not static. They change rapidly, and you've got to take that into account, because if suddenly something were to happen to one of the key stakeholders in the business and you didn't have a plan in place, well, it just puts you behind the 8 ball. So whilst you mightn't consider that today is something that succession is imminent, but if, you know, God forbid something were to happen, you need to have a plan in place simply for your beneficiaries, if nothing else, to enable them to get the best value out of the business. The point about a business being a job versus a valuable asset is something that we struggle with. A lot of people will think that they're running a great business, but in essence, when they break down the bits of it, they've just got sick of working for the man, and now they've gone and found themselves a job, but they call themselves a business person. It needs to be, the business has to be able to translate to somebody else, and it has to have systems and process such that a purchaser is willing to see themselves in your role and with you no longer there. Growth, obviously staffing key. If you haven't got good people, then the business ultimately is going to struggle. And if you're always in a situation where, you know, the people that you've got are not as good as you'd hope they would be, then the sooner you get on to moving them on will improve your value of the business substantially. Not only does it improve the value for the eventual sale, but of course it improves the profitability along the line. So often what business succession does, and why a plan is important, is it forces you to review all of those issues that, you know, really we often put off for another day. The point, and the 50-50 was interesting. Most people would say that they don't know what their business is worth, or they would like to have some sort of benchmark to find that out. Stephen's going to go through a number of valuation methodologies, but ultimately having a clear picture as to what it's worth today is important, because it's also then a measurement tool as to how you're progressing. So with all of that in mind, I'll pass across to Stephen to explore the internal and external succession options.
Thank you very much, Gary, and welcome everybody to this webinar. One of the things that I wanted to go through today was talking about internal and external succession plans, and break that down into what that actually means. And I think the most important key to succession, and the flavour that will come out of today, is a successful succession plan transition is all about planning, and more planning. And I don't think you can ever do too much planning and continually review your succession plan. Succession plans should be a little bit like a will, where it's a living document that we're reviewing at worst on an annual basis, but certainly each time a major transaction occurs in your business, there may be a need to review your succession plan. Some of the most successful business plans we see are reviewed on an annual basis as part of their overall review of their businesses. And we see too many times that people who don't plan their businesses get to the end of at the end of their careers, look around and realise that perhaps there's nobody else to sell to, and they're either forced to either close their business or sell at a much cheaper price than they may have got if they'd planned out their succession and looked at key staff, the next generation, or perhaps importing some key staff into their business in the years prior to their retirement. And that leads me into talking about what an internal and external is. So internal, we're referring to selling to existing management, or some people refer to an MBO, known as a management buyout, or even passing down to the next generation. Passing down to the next generation is very interesting. It's a cultural thing in some industries. It's very symptomatic of a lot of industries, and also it's not possible in other industries. So it really depends on which industry you're in as to whether the next generation is already working in your business, has any interest in your business. Too many times we think that mum and dad wish to sell their business, and sons and daughters say thanks, but no thanks, I've gone and pursued another career somewhere else, which can lead to a bit of disappointment for the older generation, but certainly something that shouldn't be assumed and needs to be discussed. So I guess it leads to to coin the phrase, we need the right seats on the bus, and then we need the right people in those seats. And it literally is like that. So what does a succession plan actually look like? Well, it's a matter of sitting down with your advisors and mapping out exactly what your business looks like at the moment, reviewing the current performance of the business, the current performance of the staff, what services you're offering, what services you would like to offer into the future, and really looking forward with that crystal ball to see what your business looks like over the next 2, 5, 10 years, to line up with when you think you are ready to either pass down your business or perhaps retire and set sail into the sunset. What that really does is, as we've mentioned, their readiness and timing. So the readiness is all about also identifying the gaps, doing a people review, looking at what skill sets you do and don't have, and then working towards either filling those by bringing in other people, or promoting those senior managers into positions where they can one day take over from you. Sometimes you've got very talented people sitting in the shadows of your business, and that's the trick to getting those people is to actually have those conversations. Are they interested in buying your business? Quite often when we advise clients, we have those discussions with senior management. The first thing they said is, oh, I've never really thought about it. I've never really thought that one day you would retire, and I don't think I can afford to buy your business. And that opens up the conversation. But more importantly, if you don't have those conversations with those people, you'll never know. And I guess you never know unless you never go. The other thing is talking about family members, so passing to the next generation. And as I said earlier, it's really, really important to have those conversations with the next generation. I think way too many times mum and dad assume that the children will simply step in. It's certainly it's nice to think that you can pass your business to the next generation, but if the next generation don't want it, or have moved on to another industry, or perhaps through their education have moved into another area, perhaps that's not an option. And if you're working on your business thinking that that is a possibility, and then to find out that it's not, sometimes you've then got to turn to alternatives, and sometimes that may be too late. So again, it's all about having those very important conversations at the beginning of the succession planning process, so that there is no assumptions made that are going to lead to disappointment down the track. The third point there is the external, and what we mean by external is if you don't have the right people on the bus internally at this stage, that you can either bring up, upskill and bring up into senior management positions to take over the business from you, or you don't have that next generation to pass to, but you still want to or need to realise the asset and sell that asset and to crystallise value for your retirement, then you're left with the third choice, and that is to look into external. And externally, you've either got two choices. We can either package up the business, sell it to somebody completely independent, who may either be a competitor or somebody that wants to get into your industry, or we can bring in external parties into the business. And sometimes it's actually a bit of both. If we don't have the skills in the short term to step up into those management positions, perhaps we need to recruit those people. And that's about having the right people on the bus at the time. So again, we're looking at that skill gap, we're looking at the HR, we're looking at all of those shortages of what additional skills are required to bring in. And that's regardless of whether we're setting a business up to sell to a different person, or perhaps we're bringing in some senior people that we can train up in the short term who are then generally interested in buying your business. So we replace those internal management buyout people with external management buyout people by simply bringing in those people at the right time. Again, they need to get used to the culture. There needs to be a good fit. We need to recruit for fit, and that can take time to bed down. So if we're thinking of selling our business in 2 years' time, we really should be looking to bring those people in now if we have those shortages, because it will take 12, 18, 2 years to bed down those people, make sure they are the right people, make sure that they're going to get on with your existing staff, so that when they do put their hand up and step into your role on buying the business from you, that they're not going to have people leaving because it's the wrong cultural fit or they're not sending the right messages. So again, we're trying to assist those people that are going to buy your business with the best possible outcome. Because at the end of the day, we simply don't want to be selling our business and walking away and seeing it diminish in value or close down in a short period of time. You want to see your business that you've been proud of to build over those years go on and build a bit of a legacy. And whether that legacy is left with the children or whether it's left with your senior loyal staff that have been with you many years, or to an external party. Whatever the outcome is, we want to try and leave our business in the best possible shape, maximise our value, of course, but also ensure that we've set the business up for success into the future. So with that in mind, I'll pass back to Gary, who is going to talk about the next point. Oh, sorry, apologies, there's one more slide. So quick 5 steps of succession planning, just to wrap up what I was saying, is it's very important to establish a timeline for sale. Define the improvements that you need to maximise your price, and that is about the right seats on the bus, getting the right people involved, recruiting externally if you need to. Determining the value of the business, which I'll come back to in my next piece, talking about the valuation methodologies. Minimising your tax by maximising your structure, and again we have a point to talk about on tax structuring and the different types of businesses in structures coming up soon. And then also beginning the marketing program, planning enough lead time in selling your business to make sure that you allow enough time for the business to be marketed and give you the best chance of maximising your value. So with those 5 steps in mind, we will cover some of those in the upcoming slides. I'll pass back to Gary for his next point. Over to you, Gary.
All right, thanks, Stephen. One of the things that obviously comes through this process is that none of this is particularly easy. The conversations that need to be had in looking at the essential steps to developing a strong plan are all those hard conversations that you need to have. One of the points that we make at the top of the thing is that we need to look at the business as separate from the individuals. We need to depersonalize or objectify or commoditize or whatever you want to call it, but create the systems such that the business will stand independently of the individuals. Now, for those of us involved in personal services, professional services, or have had a business where the personalities is substantial, That's a very difficult thing to do because we innately think of the business and ourselves as almost one and the same. But that's not going to create succession unless we can navigate over the top of that. So understanding that the business is separate is important. Obviously, who the key stakeholders are. So in that, there can be obviously family members, there can be bankers, there can be obviously the existing employees, as Stephen's mentioned, that may or may not be interested in buying the business. There'd be customers, suppliers, all of whom are part of the value chain that the business represents. We need to get to know who they are to be able to determine who the best person might be to approach, and strategically create a value proposition that's compelling, that and will stand the due diligence of review. In terms of the family issue, it's often the family that have sacrificed over a long period of time, while mum and dad or either have basically said, look, guys, we can't go on holidays, we can't do this, we can't do that, because the business is the thing that's loomed large as the children have grown up. So they often have a very vested interest in the business and how it should be run and how it should be passed on, how the legacy should be managed. But as often as not, they're not addressed in the conversation, and we think that diminishes the outcome quite substantially, because you get a lot of confrontation at the wrong point in time when these things should be more streamlined. So it's having that adult conversation with the family, which obviously leads into the other point about whether the family members actually have the skills to take on the business. That equally can be a hard question for the son or the daughter that's been in the business the last 20 years, but they simply don't have what it takes to run it. And in that case, you're far better off selling it and probably jettisoning them into something that they're more skilled at running. What the owner's plans for growth and exit, if there are no plans for growth and exit, you've got to create them. You've got to be able to think those through. And that's certainly part of the plan, because a purchaser will want to see blue sky. The last point is the emotional component of how the owners move on from their legacy. Often overlooked, and everyone says, oh, no, I'll be happy to retire, can't wait to play golf. But 3 months in, bored senseless, and then starts looking around. So you've got to be able to convince a potential purchaser that the vendors are serious about getting out of the business, and the emotional, financial, and logistical nature of that process has to be able to be mapped out so that people can see what's required, or in fact that they're serious about the sale. The next point that we lead into is the discovering the major challenges you'll face and how to overcome them. Now, obviously, there's no easy way of doing that other than fleshing out the issues. So we've identified a couple of points here in this next slide that talks to consider all of the steps involved and the weaknesses that we have. It's sometimes very easy for consultants and owners to look at the positives, but what are the weaknesses, and have we got a plan in place to address them? Because ultimately it's those things, it's those chinks in the armor that we may have overlooked that will diminish the value quite substantially once we get into negotiations. Look at the future opportunities that this new world is presenting. Obviously technology, the pace of change is something that's smashing all of us. The fact that we can have this webinar all in different locations is something that wasn't available many years ago, or certainly wasn't to me. So I think the thing that we've got to look at all of our businesses and say, well, what are those things that we can take advantage of, and what are those things that are going to crush us, and how are we structured to deal with those? Are we able to have adult conversations with the key players? I raised that point earlier in relation to the children. The adult conversation is where it's really been very, very tough. Often that can't be done by mum or dad, and you need to sometimes bring a facilitator in to manage that conversation, because it's just simply hard. And of course, as I referred to earlier, what are mum and dad going to do once the business is sold? Can they move on? And if they can't move on, then what's going to happen? The other aspect to that is the old adage about delegation. It's not abrogation. In other words, if there's going to be a successful transition of this business, the owners have to have a plan as to how they're going to work with the new people. So we've also got to be able to build a transition plan into any succession. So with that, I'll hand back to Stephen to look at the tax and structure implications.
Thank you, Gary. So we're only on a short webinar today, and I certainly don't have enough time to go through all the tax and structure implications. Tax is obviously a very complex area. In anything that we do, the tax office is always there watching us very closely. So tax is always something that we take very seriously. I've seen many times when tax has become a barrier to selling a business in the short term, where clients are simply saying, tax is too big an issue for me right now. I'm not going to sell my business. I'm going to continue working. So it is something that is certainly something that needs to be considered up front. And the other thing to consider is the type of structure that you already have your existing business in. And the point that we've made in the next slide here at the beginning is that not all businesses are well suited to implementing a succession plan. And what we mean by that is that if we look at the main structures that exist within Australia, there's 5 or 6. We have sole traders, which some of you may be. We have partnerships, where we've either got partnerships of entities or partnerships of people. We have family trust or discretionary trust, as they're otherwise known. We have unit trust, which is a hybrid trust, which is similar to a company but has different tax implications. And then we have companies, whether that be a proprietary limited company or a private company, as they're known as, or a listed company. And a listed company can be is traditionally a limited company. It's either listed or unlisted, depending on the size of your business and where the maturity of the business is. So if we look at each of those quickly in summary, a sole trader business, and Angela alluded to it earlier, many consultants have sole trader businesses, and many times we've had discussions with sole traders or consultants where they say, well, it's just me, I work from home, I don't really have anything that I can sell, I really can't sell my own IP or my own goodwill, who's going to buy it from me, no one will be interested in buying my skill set. We challenge that by saying, well, you do have goodwill. Your goodwill is all that knowledge, that intellectual property, all the material you use on a day-to-day basis as a consultant. And with a little bit of careful planning, many of these businesses can be turned around into saleable items. That's a matter of putting your processes and procedures in place, putting your IP down. If you've got business names, trademarks, logos, registering those, creating some value in those. And basically what we're trying to do is package up that business, that sole trader business that you once thought was of no value and was simply going to be shut down when you choose to retire, and packaging up that business so that somebody could come in, perhaps shadow you for a period of 12 months, 2 years, however long you think it'll take for them to learn that skill set, learn your client base, get to know your client base. And what you're trying to do is then create value. And there may be a point when this person says, well, I'm actually happy to pay you something for that business because I've shadowed you, I've realized that there's some value, I think I can make a good earn out of this business, and I'm prepared to pay you something for it. That is a much more rewarding way and a much more lucrative way for the owner to go down that path. We may get to the end of the path and realize that there is no opportunity to sell, but at least there's nothing ventured, nothing gained is what I've said to clients many times. Is it's not going to cost any more to set the business up for sale. It's something that you do every day. It may be just a matter of putting pen to paper in those processes and procedures, and then finding that person that is coming in and certainly market yourself. So that's something that can always be considered. Partnerships obviously can own a business. There's many partnerships in Australia that have businesses. They are certainly something that can be sold. Capital gains tax in selling assets is something that needs to be considered. There's for small businesses, many different small business exemptions and discounts that are available. And there's also then income tax implications for selling businesses, maybe getting profits out of the partnership, etc. So again, we don't have enough time to talk about this in too much detail, but it's I guess the message from here of partnerships is yes, partnerships can sell their businesses, and in terms of the succession plan, can certainly be considered. A family trust is a little bit unique. Again, without going into all the nitty-gritty of the Tax Act, selling a family trust is near on impossible. But however, what you can do is look to sell the assets out of a family trust. So it would be more of an asset sale rather than a share sale or an entity sale. And in doing that, again, there's some careful planning. Perhaps there's an opportunity to shift some of those assets into an entity that can be sold, or we're looking to simply sell those assets out of the family trust. Again, there's capital gains tax implications to be considered when selling assets, reviewing cost bases, ensuring that you're minimising your tax. family trusts or discretionary trusts are eligible for the small business capital gains tax discounts if you're in that small business space. So something that you need to talk to your advisors to or talk to DFK about. But again, the message I guess there is family trusts are not the sort of entity that can be sold, but certainly the assets can be sold out of a family trust. And whether that's a two-stage process of selling into another entity that can be sold, which requires some careful planning and tax considerations, or it's simply offered for sale in the first instance. Unit trusts, I guess for those that are not familiar with unit trusts, think of unit trusts as similar to companies. They don't pay tax in their own right, but most of the rules are very similar. Capital gains, again, there's something that needs to be considered. Capital gains tax for companies versus capital gains tax for unit trust is different. And the most important thing about unit trust is being able to get the proceeds from the sale of any assets out of the unit trust if we're selling assets, or also consider the sale of the units in the unit trust, which can be similar, think of them similar to shares. We can sell the units in the unit trust, and the unit holder will make a capital gain if there's a profit. And again, there's some capital gains tax implications that need to be considered when selling those units. Companies, most people are familiar with companies. They've either bought shares on the market or they own shares in their private companies. Shares can be traded readily. Shareholders agreements are normally drafted. Sale of share agreements are normally drafted when we do these transactions. And also income tax needs to be considered. Again, there's nothing to prevent us selling assets out of companies, but in most cases, companies, when they're selling their business, normally sell the shares. And for two reasons. One, it's a nice, neat entity that can be shifted across to new shareholders simply by transferring the shares and appointing new directors. And also there is some capital gains tax advantages for selling a company shares versus selling assets in a company. And just quickly on that one, basically what we're saying there is that the shareholder sells their shares for a capital gain versus selling assets out of a company, which then leaves the proceeds from sale inside the company. We're still left with the company as a shell, and then we've got to look at how we get those profits out of the company, which again may have some tax implications. And under the current rules may not be as generous as selling the shares where you're receiving capital gains tax discounts and accessing yourself to small business exemptions. So again, it's all about planning, and tax is very much about planning in everything that we do, but particularly when we're looking at the succession planning side of the structuring. So we've covered those points. Just to recap, we've talked about not all businesses sell. Obviously, sole traders and family trusts are something to be aware of there. We've discussed which ones work and when. What can I do now to help me better? I think the message there is to plan, look at your structure, review your structure, look at who the directors of the company are, look at who the shareholders are, making sure that if we're setting the business up for sale in 2, 5, 10 years' time, that there's something that we don't need to do now, or there's something that we could do now that can help us save some money down the track. Income tax legislation is constantly changing. Legislative change is one of the things that we spend a lot of time with clients on. We can only plan for what is currently legislation. I think it's too much risk to crystal ball that the capital gains tax discount will or won't be around in 5 years' time. We can only plan for current legislation. The tax office are changing company tax rates at the moment. Again, we can only plan for what company tax rates exist at the moment. The legislation gets changed too often to be able to really predict with any certainty going forward. So what you can do now to help me, I think again, plan. I'm sure all tax outcomes are considered to ensure no surprises during the process. So again, there's nothing more frustrating than thinking you've set your business up for sale, you've got the right people on the bus, and then the advisors come along and say, by the way, we've got this unexpected tax bill, or we've got stamp duty to pay, or we've got some other unexpected amount that we need to pay. That can throw a real spanner in the works because we may have fine-tuned the sale of the business to line up with your retirement plans, your superannuation, etc. If we've got a lump sum amount to pay that we weren't expecting, that can make or break the succession plan. So it's really important to understand all the tax implications and exactly what you're up for and when. Timing of taxes is also very important. In some cases, we can, by shifting share structures and selling assets at certain times, we can defer tax, which can have a big impact on the timings and selling of the assets. Consider what assets are being transferred and to who and when. I've touched upon that earlier. It's really important to understand what assets you're selling. Are you selling shares in the company? Are we selling the assets out of the business? out of the company? Is there goodwill to be recognised? In many cases where you've started the business yourself, goodwill has no cost base. So if we're selling goodwill, it normally has tax implications. And again, it's understanding what those tax implications look like and also the timing of them. Change in control considerations and timing, particularly around selling to next generation. Selling to next generation, normally we pass the business down. There may or may not be consideration paid, but given that it's not arm's length, we're selling it within the family, the tax office may deem there's considerations, which normally results in some tax liabilities. So many people that I've talked to have thought, well, I'm just passing it down to my son or my daughter. There is no tax implications. I can just walk away. That's not always the case. It may be the case in some instances, but it's certainly not always the case. I think it would be very dangerous to assume that you simply pass down these assets without any tax implications. And one of the things that quite often catches people out on these ones is stamp duty on the transfer of land and or some of the business assets. So again, the state governments are putting their hand out as well as the tax office. So it's something that we really need to be very, very clear with our clients as to what the implications are and for the clients to understand those implications. And then there's estate planning. Estate planning normally does go hand in hand with succession planning. As Gary said, none of us are immortal. We need to plan for these events. And it may be intergenerational assets particularly passed down upon the estate planning, upon an event happening. And it's very important to understand those timings. There may be a memorandum of wishes, for example, which is whereby the previous generation have left instructions for trustees of trusts, trustees of their estates, certain assets to pass down to the children, to the next generation. And again, without going into all the estate planning, which is a topic in itself, the succession plan should work in with your estate plan, just so that we're prepared for all bases. So the other thing that I wanted to touch upon before I pass back to Gary is valuation methods, which is the next slide. If I can get that up and running. Maybe, there we go. So understanding the core business valuation guidelines. So again, understanding core business valuation guidelines is a topic in itself. So what I wanted to do today was just touch upon some of those valuations and how we go about valuing businesses. Every business is valued slightly different. There is no hard and fast rule for businesses, but what we have developed is a downloadable handout, which you can see on the right of the screen, hopefully, where you can download a table that we've come up with, which talks about 5 different valuation techniques. So I just wanted to cover those today, and for those who haven't downloaded it, I'll just go through these in brief. So there's the capitalisation of future maintainable earnings. There's a discounted cash flow model. There's the net tangible asset, or what we call net asset backing. There's a rule of thumb or an industry norm, and then there's a cost to create or a entry cost valuation. So I won't go into all of these today. We've given you the downloadable document, which gives you some of the strengths and weaknesses of each of these methodologies. But just to touch upon them briefly, the capitalisation of future maintainable earnings is probably the most widely accepted. And what we do there is we normalise the earnings of your business. Let's say it may be over the last 2 or 3 years. We come up with an average. And by normalising it, what I mean is we take out any large, special, unusual, one-off type transactions. Or perhaps you're paying yourselves a salary over and above what would be considered the industry norm. We can adjust for those events so that we end up with your profit and loss statement being normalised, taking out all of those little one-off things that are unique to you, and really taking you out of the equation and making the business look like it would if somebody else was running that business. Once we have that number, we average that and we apply an industry multiple. And those industry multiples are very widely published, and most of your industries would have an industry multiple. From that, we usually use a range of multiples, and from there that determines multiple times future maintainable earnings gives us a range of the valuation. It's really only meant to be an indicative. It's meant to start conversations. It's not meant to peg your business to a particular number. There's many factors that go into negotiating the sale of a business. This really just gives us an indicative range to work with. And from there, it's a matter of working with your potential purchasers and the vendors to then negotiate an ultimate price. That price may be determined by stock on hand at the date of settlement, current valuations of property, and many other factors. Discounted cash flow, again, it's another one that's widely used. Some industries use discount cash flow regularly, other industries not so much. Just conscious of time, I'll continue. I won't go into all of these in detail. Net tangible assets. So in some cases, net tangible assets, particularly where there's property, which is easily valued according to the market, is a readily available method of valuation. Rule of thumb or industry norm. So some industries are very unique in what they do, and there is a rule of thumb where it's 3 times earnings, it's 2.5 times a multiple of EBITDA, it's 3 times net profit after tax. They're very widely accepted normal benchmarks that are in that industry, and you'll know in your industry whether it's a norm to use that type of valuation, or it's a multiple of earnings, or it's a discounted cash flow. And then the cost to create an entry. So basically we're looking at what it costs to create your business versus what it would cost to create a new business. So we go out to the marketplace and say, well, sure, you can start up a new business, it'll cost you X. However, we already have an established business in this industry and this is the price. And then people can make a comparison between the two to see whether they want to buy an existing business or they want to start their own business. So just looking back at that list that we've got there, what consideration, if any, will be paid and when, particularly around management buyouts. So quite often we see in management buyouts where the vendor is helping out very senior management, there may be some vendor finance offered. And with vendor finance, obviously we need to negotiate terms. Is interest going to be charged? What are the commercial terms that it looks like? And again, those discussions need to happen with your senior management as you're leading up towards that sale event, to give them an opportunity to get comfortable with the fact that they're going to owe you money going forward, over what period, what your expectations are, etc. We don't want to, again, we're trying to leave a good legacy for these people. We don't want to put barriers in place where it's going to cause issues between you and your senior management post you leaving the business. If you pass into the next generation, is son or daughter going to be paying for this business, or are they just assuming they're going to inherit it for free? Where perhaps mum and dad are thinking that they're going to receive some money and help fund their retirement. And again, it's very important to have those discussions up early. Application of any discounts on valuation. So if we're selling particularly to internal people, they may have assisted you to build the goodwill of the business. Is it fair to be selling it to them at full market value? Or should they receive a discount for all of their years of service and hard work in helping you build the business, compared to somebody that would be coming in from outside who hasn't been on that journey, perhaps where they would be paying full market value for the business. So again, it's a matter of having that discussion with your advisors and also with your senior management. What needs to be done to affect the valuation? So we talked about earlier about major transactions and related transactions that can be adjusted to get our future maintainable earnings. It's a matter of reviewing your profit and loss, going through your last 2 or 3 years' performance with your advisors and pulling out those transactions. So there may be something now that we can do that will affect that valuation, particularly given if you've got a large multiple. So if we've got a $100,000 transaction, for example, that can be pulled out of the profit and loss, and we're receiving a 5 times multiple, that's a $500,000 difference to the valuation of your business. So we can add a lot of value to the bottom line very, very quickly by looking at the abnormal transactions or those one-off transactions and applying a multiple. So it's really, really important to be doing that, because we may be leaving significant value on the table for the next person. And I can guarantee their advisors will be looking at those sorts of opportunities as well, which is something that we do when we're looking at buying businesses on behalf of companies. We're looking for those little gems that perhaps the other side have forgotten about. Who will fund the transfer of the business and how? I've touched upon that from a management buyout point of view, but again, it's a question of whether there'll be some vendor finance, whether your internal purchasers have the ability to borrow money, whether it's against the business in a cash flow lend, or it's secured against assets such as bricks and mortar. Intergenerational succession plans, we've talked about that. And then also the last point I wanted to cover was just looking at the core assets of the business, the assets that must stay with that business to be sold and to maximise your value. First is perhaps there might be some surplus assets. And what we see quite often is where companies or trusts are sold, there might be a surplus asset, e.g. a property that is not intrinsic to the business. And the first thing we would look to do is to say to the owners, well, do you want to leave that property in the company to be sold, or do you want to get that out? And again, there's capital gains tax considerations, and there's also transfer of duty. There's duty on the transfer of that asset, getting it out. So again, it's a matter of understanding what assets are in that company or that structure that are key to the business and what are surplus, once we come up with our surplus list, what are we going to do with them? Are we offering them for sale, or are we taking them out? Perhaps they are something that that has been in there for many, many years. We may have pre-capital gains tax considerations, and quite often, sometimes we leave the surplus assets in the entity and we actually sell the business out because of the pre-capital gains tax nature of those assets. So again, it's all about understanding what you've got in your structure and planning for all of those events going forward. So with that in mind, and if I can change these slides again, I will hand back to Gary, bear with me, to talk about creating an action plan moving forward.
Terrific, Stephen. That was very comprehensive, and I think you can see generally the overlap with all of the issues that we're addressing. And the fact is that whether it's evaluation, financing, tax, all of these things are big conversations to have, and a lot of detail in relation to each of those could be drafted. What we've identified in the next slide is 10 points. Everyone likes to have a sort of a 10-point plan, and that's what we've done. Obviously, with Stephen and the slide he had earlier with the 5 points to address, gave us some sort of sense of issues that need to be addressed. So the fact of the matter is, with any sort of plan, is that every one of these points could move into a further 7, 8, 10, 12 points. So we don't want to get tied up in knots about the number of points. The issue would be that the conversation you need to have about a succession plan is to be robust and thorough. One of the processes that professional services are often engaged to do is to do a due diligence. A due diligence is basically to look at what are the weaknesses in the businesses and what are all the reasons why what's been offered is not actually the thing that the purchaser will end up buying. So if you look at your business the way that a due diligence would, in other words, run that same ruler of review over your business and over your plan in reverse. Very, very difficult to do because we all have our rose-colored glasses and we all believe the dandelions and butterflies story that we seem to share about our own business and our own efforts. But it is critical that you have that hardline review. To this end, the 10-point plan gives you a checklist. And to the extent that you diminish or reduce the review or the thoroughness of the review, simply opens you up down the track to having those questions being asked by a competent advisor to a purchaser. And once they've got you on the ropes in any sort of negotiation, obviously the value of the business will diminish. It's a bit like when somebody's selling a car and then the purchaser will come in and point out all the mistakes and the dings and the scratches and all that sort of thing. Basically, what it does in the vendor's mind is it devalues the proposition. Then it gets to the point of desperation and they sell at any point. So if you understand that, then do that in reverse, review your business with that mindset. Obviously, the desired outcome and timing is critical. If your planning is somewhere for 5 years hence, you've got a lot of time to sort of start putting these things in place. If it's a 2-year plan, you're pretty tight, right? So you need to get your skates on, because obviously if there's any remedial action that needs to happen, you need to crack on. Current people and resources, well, we've been through that. Having right people in right positions, once again, some tough decisions, and sometimes can involve heavy costs of redundancy and letting people go, and also understanding the value that they take out the door with them. So sometimes it's worth hanging on to that intellectual capital that vests with key people to try and tie them into the value proposition that you might bring a purchaser to pay for. Share the succession plan with key people. Can't stress that enough. If the key people aren't aware of what's going on, then when that conversation does come up, and let's face it, they're all thinking it. They're all thinking that the boss is getting on. It's my turn to step up to the plate. Then let them know what's going on, because otherwise you end up having people move on who you would otherwise want to retain simply because you never had the conversation. The milestones to measure progress, we talked about evaluation. One of the reasons why we believe evaluation is a great idea is if you said your business today is worth $1 million and you put all of these remedial actions together and then you rerun the metrics in a year's time and find out that on the same measure it's worth 1.25 million, that extra 250 grand is a capital gain. As Stephen's mentioned, there's a number of concessions about that over and top of the profits that you've made for that period. The execution process, once again, you know, you can have a great plan, but if you don't do anything about it, well, you might as well throw the plan in the bin. The monitoring and the checking of milestones, pretty key that you look at how things are going. Allow for the delays and external factors. So if you said that we're looking to sell my business in 2 years' time, but it's a style of business that is seasonal or is it's going to take some time to sell, then you've got to allow for that. I was in a conversation this morning with somebody who's looking at an overseas buyer. You know, we're looking at a 2-year plan just to basically engage with them, but you know, once again, substantial value is attributed to the business as a consequence. Last point, do you have a backup plan? You know, what's your plan B, plan C, plan D? Because rarely does life service up a situation where it's nice and straightforward. It's generally pretty complicated. So from our point of view, Stephen's used the point of plan, plan, plan. It's obviously a recurrent theme. The issue would be that your backup plan needs to take into account that if all of this goes awry, what do I then do? Now, tangential management is a skill that we've all got to develop in a changing environment, and especially in one of rapid change. So more important than ever to have that backup plan. Can be insurance, or it can be, you know, a safe harbor for a potential purchaser, but ultimately it's pivotal that you have that. So given that the time is running shy, I think I'll just pass back to Stephen to review the next steps to wrap this up. Thank you very much.
Thank you, Gary. Okay, so I just wanted to touch upon a little bit about DFK. You've heard from myself and Gary today. We're both partners of DFK offices in Melbourne and Perth. And just to touch upon what DFK is all about, we take care of a number of clients across many industries, providing accounting, tax, audit, insurance, business services and advisory services. And we're here to help you, here to talk to you about your plans, help you create those plans, review a plan if you already have it, and more than happy to spend some time on the phone with you or arrange a meeting with you to talk about your plans if you are still interested. DFK has 14 members around Australia and New Zealand, and we're also in 92 countries of the world. We have seamless client services across the country. We all work very closely together, and we have a great referral network between ourselves. So if somebody has a particular skill set in an industry in another office, we're more than happy to refer you to those people. So I guess the theme of all of that is to, again, as we said earlier, plan, and continue to plan and review your plans as often as you can. Sorry, I'm just going the wrong way on the slides. Sorry, try again. Angela, help me.
There you go.
So how can we help? So back to you, Angela. Sorry.
Not a problem. Thank you, Stephen and Gary, and thank you for everyone who has stayed with us throughout the webinar. There was a lot of information here that you've been taking in today, but rest assured, a recording of the webinar as well as a copy of the slides will be sent to you along with the handouts that are available here today. So really advise you to take your time to go back through, because the most important part of any webinar or training that you're in is the action that you will take. So we have mentioned that there is a complimentary consultation available if you would like to dig down deeper into your specific scenario, but we do have a few minutes now if you would like to ask a question of Gary or Stephen whilst we're on the line. And of course, yes, there is many other ways in which DFK Australia New Zealand can help, and some of those are on the screen in front of you now. But first things first, let's see if there's any questions about today's presentation. I'm just going down through the control panel. Don't have any hands up at the moment, probably all digesting what it is that you've heard today. But feel free to contact us if you would like to go to the next step, which is an invitation for that complimentary succession planning discussion. Now, there is a link here at the bottom of the page, at the bottom of the screen, that will take you through to a couple of quick background questions, contact details, so that we can be in touch and dig down into your specific situation. I don't think we have questions at the moment, so this is a simple thank you for spending your time with us, and we would really appreciate, there is a very quick survey that will pop up as I close this webinar for you to just give us a quick feedback. Now that you're in touch, we will come back to you with future webinars that we're running in the new year of other areas that we believe are of value and interest and relevant to you as a business owner across all of those different industries that you shared with us today. So thank you again for spending your time with us, and we'll be in touch to speak with you again very soon. Oh, hang on, we've got a question. I take it all back. Rob Masley, I'm just going to unmute you if you did want to ask a question or if you want to know more. So, Rob, are you still on the line? Hello, Rob. Nope, okay. He's gone shy on us. Well, Rob, you will be able to reply to the email that comes through with the recording if you do have a specific question, or of course, grab one of those succession planning consultations with us. So back again to say thank you. If you can take the moment to complete the survey, and then we look forward to taking care of you on another educational and informational webinar that we'll be running a full board of in the new year. So this is Angela Raspis from DFK Australia and New Zealand. On behalf of Gary and Stephen, have a wonderful rest of your day, and we will talk with you again very soon. Take care.